So Facebook in 2012 was a lot riskier investment than it is now. I'm not saying it's not risky now. I mean, it's still riskier than what you want to call Coke, but it's not as risky as it used to be. So these betas also change over time. So I don't want to use just because I have over 20 years of return data on Google doesn't mean I should use 20 years of return data. If I do, I'm going to overestimate its beta because that company is not that risky anymore. So let's do number 3. Or the so-called market risk premium. Which is expected return on the market portfolio minus the risk-free rate. So this is how much premium market is giving over and above risk-free rate to entice us to invest into risky assets in general. Well, one way is to go with the historical averages. Since 1871, we have data on returns on S&P 500 and treasury bills. In fact, I'll show you a source where you can get this data. If you enter multpl.com, multpl, and let me see. For example, 1-month treasury rates. You have data or let's look at the 10-year treasury rate. You have data on this since 1871. Okay. It went pretty high, late 70s, early 80s, when the inflation was also high. It went pretty low back in COVID days, so on and so forth. But we also have data on historical prices of the S&P 500. You could also download these things. If you say table by month, I mean, these are the end of month numbers or beginning of month numbers, all the way to 1871. Using those, we see that, and assuming S&P 500 is a proper proxy for the market portfolio, which is a big if. But at the level of this class, it doesn't matter too much. Market risk premium should be about 8%. So historically speaking, on average, if you invested in the S&P 500 index over the last 150 years or so, you would have earned 8% above the 10-year treasury rates, which is a pretty big number. But the trouble is, same idea, is the risk appetite of investors the same as the risk in 1871 is the same as the risk appetite of investors now. First of all, those are very different market environments. Until about 1980s, there wasn't much electronic trading going on. I mean, NASDAQ itself started in 1971, and that was a communication network between the brokers. You and I had no access to it directly. We could call our brokers, and they would tell us what was going on, but it wasn't like it is now. I go to Robinhood. If I pay $5 a month, I can see all the order flow on any given stock at any given time. So-called gold membership in Robinhood. Other brokers have similar things. And two, there were a lot of restrictions. We talked about when we were developing that efficient frontier. For example, there's a cost to banning shorting, right? Why you're not allowing negative information to be reflected in the market. And we have seen the way that was reflected was for any given expected return, you had to bear higher risk. So if you wanted to earn 8% over and above the risk-free rate, you had to bear higher risk. So in some sense, the market premium in during the before the last 40 years or so was much higher. For me to be enticed into buying stocks, I had to be given a lot of reward. That's not the case now. People can short anything they want. That means negative information is reflected in the prices. So it's not a good idea to do it. You could use over the last, I don't know, 10, 20 years maybe. But even that kind of is iffy. You're looking back. But expected return for the market is about the future. You can develop statistical models to do it, which are incredibly hard to get a lot of precision. Because if you could estimate the returns with a lot of precision, then that means you know a lot of things that other people don't. And one way to look at it is to use uh, spreads on risky bond investments. I typically use spreads on single B rated bonds at a multiple of it bets. Let's go to, I can't remember. Oh, Feds spread right now it's about 3.25, but historically that wasn't necessarily the case. Let's look at max. We have data on this since 90s. This is late 90s. It was relatively small. Why? Late 90s were raw periods of the market. 98 was when all the dot-com companies were around. Then it went up. During crises, it goes up. So markets' appetite for risky investments changed over time. When I do this for a living, I typically use a regression model to kind of estimate it. But I basically do single B plus 2% or so, something like that. There are other creative ways of doing it, but I'm not going to do this in this class, but in the investments and portfolio management classes, we will. These days, single B spread plus 2 points is a good estimate of the market risk premium. For example, these days, that would be between 5 and 5.25%. Now, how do I make use of this? Let's make a calculation of